let me start the webinar. Good day to one and all. This is Dr. Sivaraman of iknowindices.com. So I'll be presenting today the twin webinar which I give once a month, and it is entitled Tracking the Forex Market Together. So the basic idea of choosing this particular topic is that I want it to be an interactive webinar so that I'll explain my concept and also give the trading ideas and take the positions. And subsequently, during part 2 of the webinar between 14 and 14:45 GMT, I'll show the results of such trading decisions and try to get your questions and answer if there are any doubts with regard to the trading decisions and also market reading technique. So that is why it has been given in 2 parts. So today is September 11th. So between 9 and 9:45 GMT, I'll be giving the part 1 of the webinar. So it is a simple market tracking technique, and it could be effectively used along with that of the trading strategy so that we could be able to earn consistently from that of the market. So in order to track the market, there are certain components which are to be taken into consideration. So first of all, the derived forecast. So this is a statistically derived forecast which I generate using a statistical algorithm and try to post it in my website, and also I give the brief outline in fxtrade.com for all the 5 days of the week. So on Monday, I give the Asian session live market analysis webinar and try to give the focus like this. So for 9th to 13th of September, on Monday, 9th, I have given the expected market moves for the various sessions. So today is 11th of September, the midweek. So the expected market moves are dip and firm up move during that of the Japanese session, and swing and slide during that of the European session. You could have seen that GBP quickly made a jump for the data and subsequently not breaching the high for more than 30 minutes, and they are slowly expected to make the slide. Then swing and firm up during that of the European session. So this is the forecast for the day, and which is available in FX Trade website. So we use the statistically derived forecast as a guideline. And for intraday trading, we do the market reading. So on Mondays and Thursdays, I do the market reading with using the live market code page. And this is the live market code page, and I'll give the link for the same. So with the help of the live market code page, we should be able to track the market. And for that, what we need to do, we need to note down the highs and the lows set around 3:30 GMT in 4 majors and 2 commodity pairs, and use them as the reference levels for the day to identify the type and sequence of market move. They do it using the GMT time frame because it is a 24 hours market, so we use the GMT time frame. So in the market reading technique, we use only the live market code page. Besides, we need to know the session timings. So the market tracking should be done with the help of the 3 sessions of the day, the timings followed by the other players for the 3 sessions of the day. This is the link I have given it in the chat window. You can use it to open the live market code page, and it might be slightly delayed, but you can compare it with your platform and try to find out how much delay it is. Still, you can use it as a reference page for understanding the market moves. So for that, we need to first of all have the link for the live market code page, and the live market code page should have the following components, namely the currency pair, the symbols, 4 majors and 2 commodity pairs, besides the bid and the ask. The spread can be any, that is immaterial, as long as we are able to decisively make profit. 1 or 2 spread variation doesn't matter much. and also the high and the low set for the day, and the net change and the GMT time frame. I try to keep a distance and speed. Then, as far as the session timings are concerned, the players have the following sessions. Japanese session is from 0030 to 7 GMT, and the gap time is from 7 to 7:30 GMT of a 24 hours market cycle. The European session is from 7:30 to 13 GMT. Now we are 9 GMT, 907 GMT, and the start of the European session is from that of 7:30. It is a new mic. Then 7:30 GMT, the European session starts, and now we are at 9 GMT, 1.5 hours from the start of the session. Then European session gets over by 13 GMT. Then subsequently US session starts by 13:30 GMT. I'll come back for part 2 of the webinar by 14 GMT and try to explain for 45 minutes how exactly the market reading has to be done with the help of the live market code page, and the US session will get over by 20:30 GMT. So in between the sessions there are 30 minutes time gap, which is referred as a gap time. And these gap times wherein the orders from the other banks, especially with regard to the currency conversion trade orders, do not flow into the market because of the local start time, variation with regard to the local start time. So 9:30 the banks start the currency conversions. So invariably you find during this particular time frame, 7 to 7:30 GMT, the local banks do not place their currency conversion orders. Then the players try to make use of that particular time to make the false move or the stop in the market. And then again, between the European and the US session is 13 to 13:30 GMT gap time. And that particular time also the orders do not flow in, and the players try to make the false move and also the stop and move. Then between the day 20:30 to 0030 GMT is the gap time of 4 hours. And that time also you come across quick moves happening in the market, sudden drop or sudden rise sometimes. And that is being done in the absence of big orders from the other bank. Because the players have got a specific type of orders, and those orders are being used, and those orders will penetrate into the market to their desired level. Suppose when euro is around 1.3271, they can simply punch as 1.3202 in the specific type of order, which will directly drop euro without filling any of those orders. Without selling in the market, it will try to look for 1.3202 with a specific quantity of order. When they specify the quantity, it will not fill the small order, and it will only try to fill the specified quantity order. Say 1 million lot of dollar. If they fill it, and it will look for $1 million lot, and it will not look for one standard lot or mini lots, etc. That is, when they use such orders, you find the platforms do not fill your order, and your order remains there, but the market goes below that. So this is the main reason, because the banks use such orders during such gap time and try to fill the stops of the traders. Ray has doubt that London market opened at 8 PST. See, if you try to follow those timings, then it is up to you to do it. I have no questions or no objections to that. But these are all the timings followed by that of the players. So if you want to follow the players and try to trade along with them, then we need to follow this. It is not my own timing. They are all the timings of the players. So the players always misguide the traders by giving a different information. For example, let me give a very blunt situation. They advise all the traders to follow the charts, but they don't follow charts. That is the biggest problem. So the players advise everybody to follow the local time and all other aspects. But the players do not use it. What they use it, they try to get exactly the inside information, whether the traders are net long or net short. Accordingly, they make the decisive moves in the market. So they have always a win-win situation, whereas we have to speculate whether the market has to go up or come down. In order to justify that it is not speculation, it is scientific study, we try to use the charts. And when the charts misguide, immediately we say that it is an error in our understanding. Or sometimes we say that technically the market has to go up, but fundamentally the data was bad, so the market has come down. So technically the market has to come down, but fundamentally the data was strong, so it has to go up. That is how we try to give the interpretation without accepting it is really misguided us. Say for example, 8:30 GMT, there was a data release from UK, and that was positive with regard to the unemployment claim, and GBP went up quickly. In tandem, Euro also went up. Okay. It is a market sentiment, so Euro also went up. But after forming 1.5826, GBP is supposed to be very strong, whereas it has made a drop. It has come to 1.576869. Why? What went wrong? So technically it was overbought, so it has come. So fundamentally the data was strong, so it has come. So that is how we try to cheat ourselves, by giving alternative excuses. So if you want to follow, then definitely I have no objections, and I don't have any influence with regard to your trading decisions, but I am only giving my views with regard to the market. Okay. Sorry for the inconvenience with regard to the mic problem. I'll continue with this. So as far as the tracking the market is concerned, we need to follow the session timings followed by that of the players. So once we follow the session timings, then we'll be able to really understand how they are trying to manipulate in the market. So for that, one of the important aspects is the session timings. So with regard to the market reading, the first one is the live market quote page. We have to use the live market quote page in order to find out what sort of moves they are making in the market. Then the second is knowing the session timings. So the session timings are given here. So after noting down the session, we are now in the European session. So it is 9:30 GMT, 2 hours past of the start of the European session. Then what sort of moves they are doing it? For that, we need to know, we have to note down the initial lows and the highs using the live market quote page around 3:30 GMT. Around 3:30 GMT, we have to note down the initial lows and the highs with the help from that of the live market quote page, and then also note the net change, what they are shown, and then subsequently find whether the market is closer to low or closer to high, and then try to take trading decisions. So with regard to the lows and the highs, okay, I already noted down the initial lows and the highs, which are set around 3:30 GMT in the case of Euro, GBP, USD, CHF, and also USDN, and also the commodity pairs, Canadian dollar and Australian dollar. Now, in the case of Euro, 1.3231 was the initial low, which has not been breached. The high was 1.3281. Still, it is not been breached. Currently, it is closer to 3270. It is closer to the high. Then, in the case of GBP, 1.5728 was the initial low. They made a brief downward stop during start of the European session and came down to 1.5719. And after the downward stop, they went above that of the initial high 1.5742 and went up after the data release to 1.5826, started making the slide. So if you think that the data has got the real impact, then we should be able to see that it keeps going up. Whereas instead they started making the slide. So this is what they try to do it. If somebody goes for a breakout trade and try to buy because the data is good and try around 1.58, they will see that the position is making loss. So they induce the traders by making quick moves, which immediately changes the sentiment of the traders. And when the trader commits the position, they make the moves opposite to that of the trader's expectations. So that is what happens in the market. So we need to understand how they are manipulating this way. Then in the case of USD yen, 100.14 was the low, initial low, and they breached and made a new low, 100.09, and went up. And 100.54 was the initial high. They breached and formed 100.61. So you can see on Wednesday, they clearly make either way stop-ins. Clearly make either way stop-ins. Below that of the initial low, above that of the initial high. So if you understand what they are doing it, then we will be able to really enter when they are making a downward stop-in and exit when they are making an upward stop-in. So this is what we need to understand their techniques and understand how they fool around the traders and try to go along with it of the players and try to make money out of that. Then in the case of CHF 93.41 is the initial low. They breached and formed 93.34. And the high was 93.58. They breached and formed 93.70. And now they have come within this particular range. See, this is what? A downward stop-in followed by upward stop-in. Then in the case of Canadian dollar, 1.0342 was the initial low and they breached it by 2 pips and they are holding it closer to that. And 1.0365 was the initial, 55 was the initial high. They made an upward stop-in before making a drop. So either way stop-ins in all currency pairs on Wednesdays. That is what I say. Either way stop-ins on Wednesday. Then decisive rise on Thursday and Fridays again. Then Australian dollar, 92.84 was the initial low. They just breached 92.79, become the low. And the high was 93.18 and 93.18 is not being breached. So when you understand this, how they are trying to make the moves, if you notice exactly GBP is evidence here. They, during the gap time, you could have noticed that they firmed up. Euro and GBP, Euro came up to 1.3275, 75 region during the gap time between 7 and 7:30 GMT. GBP also came up to 1.5750, above that of the initial high. Then during the start of the session between 7:30 and 8, they made a drop of 20-25 pips. And which indicated that they made a false move on the downside, and GBP they made a small dip below that of the initial low before the data release around 8:30 GMT. When they make a downward stop and understand after the data they wanted to spike it up. So there is no need to know the data actually. And if you know that the data is expected to be released around 8:30 GMT and 8:25 GMT or 8:20 GMT, they make a downward stop and be sure that after the data, positively they will make an upward move. You need not know whether it is from UK or US or whatever it is. If you know the trigger time, that is enough. And there is no need to go in depth study of that particular data, because we know very well after the data for about 10 to 15 minutes, they just make the reactions to that. And afterwards, they make their own moves. They simply discount it and talk about the next data, which is going to be released around 12:30 GMT. So that is what we need to understand. So we have to find out what sort of moves they are doing in the market. So let me just go to the other slide. So basically, they do the following type of moves in the market. A stop-in or a false move. These two types of moves happen in less than 30 minutes, very quickly. In less than 30 minutes, they make it. And one is stop-in. They go below that of the initial low. like in the case of GBP, they go below that of the initial low and come above in less than 30 minutes, make a dip for 15 to 25 pips and come above that of the initial low in less than 30 minutes and continue to rise. That is what is called as a stop it. The false move is the one, they come up to that of the low without breaching the low and they go up. And that is referred as a false move, which also happens in less than 30 minutes. Now, more than 30 minutes. A move which happens more than 30 minutes up to 2 hours. So what they do? They go above that of the initial high. So in the case of GBP, they go above that of the initial high, 58.42, and still holding above that of 58.42, but formed 57.42 and formed 58.26 as a new high, but they have not breached it. They quickly make an upwards move, and we call it as a spike, then form the new high, then stop cutting the new high for more than 30 minutes, and they continue to hold around and make the slide towards after 2 hours. So that is what happening on the upside in the case of GBP, an extended move which is staying above that of the initial high or below that of the initial low. But here the condition is it is staying above that of the initial high for more than 30 minutes. Then afterwards, they form quickly a new high and not breaching the new high for more than 30 minutes, start making the slide. So at that time, we think that, okay, it is making a small dip, it is better to buy there rather than buying it at a higher level. Then we will be really confused. Where we have to take the buy? So if you want to take the buy, note down what is the initial high in the case of GBP, 1.5742. And they are holding above that of 1.5742, but they may come up to 1.4750 or 48 before making further rise. So what is the ideal level to buy? Around 1.5750 will be the ideal level to buy. So still it is hovering around 5771. So here what we need to understand that we try to find out, okay, the resistance turned support, so we'll try to buy it around that of the support, but invariably or near that of the pivot. Then what happens? They forcibly breach and then reverse the market. Then we call it as a noise in chart reading. But ultimately, when you place an order, they will fill your order, fill your stop, and then go up. What is the use? We are not participating even though we have done extensive study of the market. So we need to understand the trick of the players. Then try to trade. Because it is a man-made market, men play tricks against men. So as long as we are human, we should be able to read other man's trick. We cannot continue to get fooled again and again. On a daily basis, if they continue to fool us, and if we continue to become fools, and we try to follow something else, that it is really helpful for them to make their own money. And they are able to consistently make money, and we get the statements in many of the websites, nearly 90 to 95% of the traders lose money in the market. Why not? Because we fail to understand it is a man-made market. And we get that information that market cannot be manipulated. And here you see a evidential example. They made the quick gain and then dropped it. What made them to drop it when the data was so positive? And sometimes you come across when the data is negative, we all expect a drop in the respective currency. Suddenly they will reverse it and rise it. So that is how, depending upon the traders' open positions, they try to make the moves in the market. Then a move which is happening more than 2 sessions and start of the 3rd session. So that means Japanese and European session together and start of US session. That is how they make the moves. And that move is referred as an intentional move. Extended move is always a quick move. That is why I always say that quick moves are false moves in the market. Quickly they gained the levels. In the case of GBP, what happened? They quickly dropped it and they dumped their positions after gaining the levels. So without accumulating higher level buy positions, they dump the positions in the market. That is why they make such quick moves. and their data release, they use it as a trigger, market trigger time, and they try to book profit. And so we don't really realize that the market has gained the level and dropped. We think that, okay, somebody bought it, the bulls have taken the control of the market, the bears have lost the control of the market. That is how we talk. But the bulls and the bears are the same. The same players, they buy at the lower level by making a downward stoppment and quickly made an upward move and booked the profit. So they are initially bears, but they are buying. And later on they become bulls and raise the market, but they book to the profit. But we become bearish and sell at the low after breaching the low, or we become bullish and try to do a breakout trade when they breach high and start going up. So now we are able to understand how cleverly the players ask us to follow breakout trade on the downside and the upside. But they make the money simply trapping such traders. So how to differentiate the intentional move from that of the extended move? The extended move is always a quick move which lasts only for 2 hours. But the intentional move is the one from Monday. You would have noticed I have been explaining in the Asian session live market analysis webinar that from European session they are supposed to gain the levels on Monday. So from Monday onwards, from 1.31 area, slowly they gained the levels, and in the case of GBP also. So I showed it here in the live market quote page. In this initial lows and the highs. See, from Monday they started gaining the levels in the case of Euro and GBP. And also in the case of USD. So after gaining all the levels today, they wanted to just book some profit before making further rise. So that is what happens in the market. So that we need to understand. So they made 2 days of intentional move, and the third day they are trying to make the other way move. That is what the forecast says. A dip and firm up move on September 11, then swing and slide move during the European session, which I give it on Monday. Then afterwards, swing and firm up moves are expected during that of the US session. So with regard to the trading strategy, so when a position is taken, we try to use the hedging order to limit the risk, and entry stop we use, or sell stop or buy stop, we use it. And then once the position makes profit, we try to keep stop at entry and remove the hedging order. So this is the first strategy. We try to do it in order to limit the risk. Then afterwards, with regard to deciding on the entry point of it, when the market is closer to that of the low or closer to that of the high and not breach the low or the high in 30 minutes from the start of the session, we try to take the positions. So here you come across, they are all in the middle level. So it is not appropriate to take the position straight away. But once GBP makes a small dip around 1.5750, I'll try to take a buy because it is an extended move. They have done it, and afterwards they are expected to make an alternative as an intentional move on the upside. Slowly they are expected to gain the levels in the case of Euro and GBP later on during the US session. So I'll try to place the orders, and if it is not getting filled, I'll modify and buy it at the market and show you how exactly the profit can be done. So for that, we need to read the market carefully. So if you read their intentions, it is not the question of the market is from heaven, so it is very difficult to read it, and we have to use various sophisticated techniques to read it. That is not at all required. So what is basically required? It might be annoying for many, but that is reality, and we have to find what the players are trying to do it. Because if you want to become a successful businessman, we need to understand what is your client's requirement and whether the clients will like this particular design, whether the client will like this particular quality. So read other man's mind is the first step in the success of a business. So if you fail to read the intentions of the players, we are not going to earn successfully from the market. So for that, I'm trying to give all the strategies. So once the market is closer to the low, we try to take a buy position, keep the hedge order to limit the risk 30 pips away from that, because normally they make the swings for 15 to 23 pips. So 30 pips is an ideal stop or the hedge order. If the hedging facility is not available in the same pair, we can use the stop. Then exit. We have to try to keep the initial exit or take profit level closer to that of the high. So closer to that of the high, we have to keep the exit and keep stop at entry once the position makes about 25 pips profit, and then subsequently trail the stop manually and also trail the take profit level manually on the upside. So if the market either hit your lower level trailing stop or a higher level trailing limit, you will be able to maximize the profit. Because many of the traders, when their position is making huge loss, they simply wait without a stop. And once the position start making 10 pips profit, immediately they book profit. Because they feel they have come out of that particular trouble after a long wait. So immediately they grab the profit when it is 1 or 2 pips. But instead, use the trading strategy to limit the risk by using the hedge. If it is hedged, you handle it on either side. And with the help of the next slide, I'll show it to you how exactly it can be handled. So if your position is hedged, then we can try to watch for 30 minutes. And if the position is making loss, we simply close the hedging order with a minimal loss of 1 or 2 or 5 pips and keep another hedging order 30 pips away from the market and start trailing it to that of the original hedged level, so that we don't block more money in the event if they go against us. But if they start making moves in our favor, immediately we trail the hedging order upward and try to keep stop at entry and remove the hedging order. So the hedging order will act instead of a stop in a loss making position. Once the position makes profit, we can try to book profit on either side. So suppose you have got a buy and 30 pips below a sell. The sell makes profit for 30 minutes. We try to see that they are making intentional or the extended move. If it is extended move, after 2 hours, book profit. If it is an intentional move, you try to wait for the 2 sessions and the start of the 3rd session. They will come down very quickly and reverse. At the time, book profit. Then afterwards, they will start making the reversal move. Then you can take another buy position and close both the buys above their average, or simply trail the hedging order on the upside till we are able to keep stop at entry in the buy position. And then when they continue to go up, we can book profit. So ultimately, we need to understand the market. Then you'll find that the market fear goes away from our heart. Then once you don't have the market fear, you are able to sensibly read what the players are doing it, and the momentum of the market by the visual look, you will be able to find out whether it is a quick move or a false move. You don't require any chart to explain that it is an upward spike or a downward spike. You certainly see the price action here, and they stop cutting the high. So if you use 1 minute candle, then what will happen? After 1 minute only, you will come to know that they have stopped it. Whereas if you use the live market code page, the very second they stopped cutting the new high, from there you can start counting that exact levels without any noise problem. Exactly, we'll be able to find out where they stopped cutting the new high and how they are making the slide. So I'm not a big man. I am sitting only in India, which is a restricted country with regard to forex trading, and I'm able to say that GBP is going to come down. So I don't have any control over that of the market, but I'm able to read and tell you that it is coming down. So people might be thinking that all the time I will be telling that I am telling that buy and sell, buy and sell. It is not like that, but we have to read their intentions and try to decide on the right type of trade. Now, we will come to that of the live trading decisions. Here. In the case of euro, the low is 1.3231. Even though this is not the low in your platform, you might have noticed that from yesterday they just carried it. That is the interbank low. And when it comes to that of 1.32, actually the low in the case of platforms were 1.3264. They breached and came down to 1.3245 and then went up. So we will try to keep a buy limit. $1.3245 with a sell stop 30 pips below. Similarly, in the case of GBP, as I explained, the initial high was 1.5742. So we will keep it. For the margin of error, we are trying to keep about 5 pips above that because they may not come exactly up to that in reverse. So they will slightly come closer to that. Sometimes the platform may not give a definite fill. So it is better to keep about 2 to 3 pips above that of the expected levels so that we will have a definite fill, and we will try to keep this stop. Okay. Now coming to that of the other currencies, CHF, see wherever the currency is showing a spread of less than 40 pips, don't enter into those currencies because they may not be able to give you a good move and you may not be able to get good profit. So instead you you look for the currency which has made a spread for more than 40 pips between the high and the low at a given time. So Euro is good, USD is good. USD is closer to the low, but they breached the initial low and staying there. So we will not take a position there because it will be a technical trade to sell below the initial low. Then in the case of GBP, I placed it, and here you find the spread is not at 40 pips, and here also the spread is not 40 pips. Here it is okay, but as far as AUD is concerned, we can do a sell and buy trade, but instead we will try to do a buy and sell trade. Because as I explained in the forecast, that AUD is expected to make the wide range swings. So let us try to look into some of the crosses. Euro-Yen, it is not near that of the high, which is slightly lower. And Euro-GBP, here it is also in the middle level. As I explained that GBP, they are slowly coming to that of 0.83 level by gaining more levels in the case of GBP, the denominator currency, and less in the case of Euro. So as a result, you find Euro-GBP drops from 0.8750 level, they started making the slide. Similarly, in the case of Euro-CHF, they are gaining the levels, but it is closer to that of the, okay, Euro-CHF is closer to that of the low. Now, as far as Euro-CHF is concerned, how we have to understand, CHF has not made a big spread of 40 pips. Whereas Euro is showing negative net change, CHF is also showing negative net change. They are trying to push it on the downside, making a downward stop and before making a rise. So we will try to buy there. $1.2394, and we will keep the stop or the hedging order 1.3244. In the case of crosses, we need to keep 50 pips hedging order because the volume is relatively less, so they are expected to make more volatile moves in the case of crosses when compared to that of the majors. So it is essential to use 50 pips hedging order to limit the risk. And also the pip variation is also big in the case of crosses. The spread is higher. Okay, let me explain to the questions which are asked here because these are all the three and only buy position I had taken in the case of Euro-CHF, which is closer to that of the low. As I explained that they are making a contrarian move, making a negative net change in the case of euro, negative net change in the case of CHF. So which is an indication that they are trying to push downward euro CHF, handling during the mid-session, the crosses, and later on they are expected to gain the levels. So let me explain. What are the questions which are asked here? I'm extremely sorry there was a problem with regard to the sound initially, and now you are able to hear me properly. Okay. Dishi has got a question. What is gap time? So gap time is a naturally occurring time between the two sessions. And during that time, the banks do not place their bulk orders of their exporters and importers. And during that time, the players place the bulk orders and try to hit the stops. That is gap time. Then John, does that mean that after pulling cable down from the high after data, they will then push it back up? Yes, they will push it back up during that of the US session. That is what the forecast says, and also we are able to see they have made a quick rise, so it is only an extended rise, and they are expected to make that drop slowly. And they take their advantage of it and try to book profit with regard to their positions, because whatever they bought it around 1.57, and from 1.58 they started booking profit and come up to 1.5750 and then buy again there. But now technically people will say, okay, it has formed 1.5826, it has come down and it has breached the pivot points or breached the support and it's gone below, so it is better to sell. Then the players take it up. Okay, fine. What do the arrow live market code page represent? That is up or down moves. Okay, I am winding up the webinar. I am extremely sorry for the inconvenience caused in between. So these are all the three orders I have placed it, and one is a position, and I will explain to you. I'll just complete the trade and explain to you during that of the US session. I'll come back by 14 GMT and take up the tracking the forex market together webinar part 2, and I'll also explain to you what happened to the trades. And meanwhile, you can follow from 9:45 to 14 GMT the live market code page and find out what happened to those three positions, orders I have placed, and also the positions, and come back to me with your questions so that I'll be willing to answer to your questions. So thank you one and all. See you by 14 GMT.